actually agree. I was very happy to see the new strategy coming out with a new definition as well. And I think the next thing that's going to happen is obviously the reporting, which is going to be coming out soon, we hope, from the Commission, and then be evaluated in the Parliament. And I think what's important here is that the best public policy is the one that mandates a framework in companies to report on what's relevant to the companies.
And that's what this does.
The worst kind of public policy is the one that tells companies exactly what to do, because there's no one size that fits all, and obviously not in this area either. So it's really coming back to the issue of materiality, which should be the starting point for all companies in this area. And so it would be fantastic to see some reporting guidance or regulation or whatever that is centered around the issue of materiality.
But of course, I mean, there will be people in the European policy-making arena who will want disclosure about things because they're interested in them. I mean, CO2 emissions would be a case in point that some people just think everybody should disclose these, and then you don't get the materiality question, and some things which are material may not be disclosed.
And I can tell you why that's a big problem. Because if CO2 emissions are incredibly important for a company like Maersk Line, because we emit large amounts of CO2, and there's a lot we can do about it to reduce it, and we're doing it. Much less important, I have to say, Susanne, for a pharmaceutical company. And more important for you to account on what you're doing to include poor patients who also have diabetes, for instance. So again, the issues that are material to the companies, if we have reporting requirements put upon us that are not relevant to the business at all, again, it will create cynicism around the whole ESG agenda and sustainability, that it's not aiding business, it's not adding value in any way. And that's the things that's exact. I'm working every day to pull that out of the conversation in our organization so that we can focus on really what's adding value to the business.
So it's very important for the Commission to hold on to this point about materiality. And Suzanne, you're nodding.
Well, I think that there's, in the conversations that I've had with the Commission, there's one commitment that I've been iterating. It's the fact that in the new definition, there was one word that was left out. And that word was a company's voluntary initiatives to be responsible. And I know that has been a very contentious discussion behind that, because many companies would argue that it has to be voluntary because you cannot mandate a company to be responsible. But if you say that it's voluntary, then it's also voluntary to report. And this is actually not as important as what you would do otherwise, because it's not voluntary to report on your financial performance. There are so many other dimensions of operating a business that are not voluntary. So I would say that by leaving out that one single word, the Commission has indicated that ESG is as important, if not more important, than anything else a company is doing.
Cool.
I think we would like to see the reporting go beyond the first 3,000 companies, for sure. Whilst as an equity investor, there is a focus on the larger companies for liquidity and index inclusion purposes. Asset owners such as ourselves are increasingly looking at other asset classes such as corporate bonds, and some of those are high-yield corporate bonds where we believe we can pick up similar returns. And some of the high-yield corporate bonds are relatively small companies. And therefore, we would want to be analysing those companies, and we want our fund managers to be able to analyse those companies in a similar way that we would be analysing the larger companies. So we would be very keen to see that reach down beyond the first 3,000.
And so you're a bit nervous about the SME sort of exemption, that this could be in the end a barrier. And actually, if it's good for companies to think about these things and talk about them, it's good for smaller companies as well as larger companies, isn't it? I mean,
I think that's right. I mean, Nest appointed a corporate bond fund manager based around one of the bases was that it took account of environmental, social, and governance information within its corporate bond analysis. And as you start to look at shorter maturity bonds and high yield bonds, then often you are looking around medium-sized companies, and we have a keen thirst to try and understand the environmental, social, and governance impacts of those, and the cash flow consequences for our corporate bond funds.
Great. Now I think we've now reached the point where it'd be very good to have some questions and contributions from all of you out there. Kerry, is there a microphone, or do people just need to shout, or is there is a microphone? So I've got one already I can see there. I'm going to make sure I get you, although my back's turned to you, if you want to ask a question. One there, and then one here next.
Thomas O'Malley from HSBC Asset Management. I have every sympathy with the company's experience of investors. Often they're coming from very different perspectives, whether ethical or engagement or for investment purposes. A lot of our discussion has focused on implicitly the investment, understanding the management of the ESG risks from the investment perspective. The PRI and often clients are looking for engagement perhaps to change, or engagement to help companies address some ESG issues better than they are currently. I wonder whether each of the panel might say what scope they feel there is in reality for investors to add value through engagement for change or for better understanding.
Erica?
I would say there's enormous scope, and I'll tell you what else is interesting. Just from the standpoint of observing a company's response to engagement, I think that gives you an enormous amount of insight into the company. Is this company proactive, or are they reactive? Are they confrontational, or do they engage? I mean, I happen to have a brand new Nike fuel band on here. So if you think about Nike, and you think about their past experience when initially shown, issues of labor and relations and everything else, and initially they just stop it dead and defend themselves. And they learned from that years ago, and now, are out there and embracing and engaging. We think about PepsiCo, and a new study from Oxfam comes out, a new index talking about the top 10 largest food and beverage companies in the world, and how are they on issues of, small farmers, women, water, air, transparency. And, Ingenuity walks out of the office to Oxfam picketers to take them in, to talk to them. Okay, so just the response when engagement comes up. Does the company go out and sue the shareholders that are asking the questions? That's interesting too, right? So from my standpoint, I think just the response to the engagement is very interesting, and I think there's enormous scope. And a lot of very large asset managers quietly engage. We don't see it. We might not see the shareholder proposals, but they are quietly and very constructively engaging. And I wish we could see those dialogues more. But to answer your question, from what I see, I think there's enormous scope for constructive dialogue.
Paul, where does engagement come in, and perhaps how easy is it to sort of draw the line between engagement that is really about value for your beneficiaries and engagement which is actually about perhaps making the companies behave better just for the sake of it, and I suspect that in the Commission and the Commission's thinking, the latter is also important, but from the investor point of view, it's value at the end of the day, isn't it?
Yes, so we divide up our engagements into value, which we believe that the engagement is predicated around financial value and financial value alone. We think there's value at risk, perhaps, or value we could get out if we point the company towards our thinking process. And there's engagement that we base around values, which is those that chime with our members, whose financial interests we are there to put first. And so that might be, in our case, as a pension fund, to think around pension-friendly policies. So engagements around that might be an area where we would look at. Most of our engagements to date have been with regulators, to be honest. We have engaged very little with companies. So we are small, we're starting out, as you know, Thomas. We have limited resource. How can we make the biggest impact given our resource? We've carefully constructed the engagements we've taken place with regulators, and we're happy to report that we've had very positive influence. The other engagement that we have had has been with our fund managers. And again, we've had nothing but positive response to change from our letters and meetings that we've had with fund managers. So I'm going to omit the part about companies for now because we're really too young and it would be wrong of me to be able to indicate any trend in our work.
Great. Mike Tyrrell. I'll come to you next. Do you want to shout?
I'll shout.
Yes.
Mike Tyrrell from SRI Connect. Very specifically, if I may, Suzanne or Annette, did you present your sustainability and corporate governance performance to the relevant sector analyst at UBS last year? Erica, did your analyst publish a research note? If so, what did you respectively learn from that? If not, why didn't that happen?
Good question. Right. Do you want to answer and start?
Yes. No, I didn't. But we engaged UBS in a completely different way because we asked Erica to come and spend half a day with our executive board on what we call training or having a sustainability dialogue on these issues. So that was a slightly different way of engaging.
Suzanne.
And I would say yes and yes in several ways. So we have had reports coming out written by Erica about the company's perspectives, also in light of new developments in the pipeline, etc. So I would say a pretty robust analysis. But then I would actually just add to it that the best kinds of engagements that we have experienced, and they would be the ones that would be facilitated by the likes of Erica, who would invite the ESG analyst and the mainstream analyst to be in the conversation at the same time. I think it's mentioned in this report also as something that is meaningful, and I would certainly concur with that because that is where you also can kind of triangulate the discussions, because we very often feel that we have to educate our mainstream pharma analysts on what S and G and also the E means for our business, and likewise for the ESG analysts, they may know too little about what the business is really about. So having those conversations in a broader group around the table is very, very valuable.
Erica, it's a bit of a struggle, isn't it, still? You give them some pretty firm guidance, do you?
We try to, I mean, it's just like with a regulatory framework. A management, in my view, should be setting parameters, set a framework, set your expectations, and know what questions we are going to ask. Any analyst who's coming to our Global Investment Review Committee knows they are going to get questions on environmental, social, and governance factors. And not all of our analysts are as forward-thinking and conscious as I would like them to be, but we're getting there. And so as a manager, can you start to force things a little bit? Same with the investment community. You can't tell every portfolio manager and every analyst and every investor how to do what they do. Everybody has kind of their own secret sauce, right? But we can set parameters for what we expect in robust analysis of risk-adjusted returns. Okay, so we can continue to raise the bar. And ESG analysis, in my view, is a tremendous starting point for inquiry, new avenues of inquiry that potentially allow an analyst to come into one day at the Investment Review Committee and say, I have found incremental non-consensus stock-moving proprietary research and analysis based on some factor that nobody else realizes yet, and I went down this avenue of inquiry, and I know this company a little bit better. So this piece of information I have is not discounted in the shares of that stock and the shares of that company. And I'm going to go out there and tell you to buy it because I know a little something extra.